country.
Like your drawings in the background.
Those were mine. I did those.
I was wondering.
I think my 8-year-old did those. But I get new drawings brought home to me almost every day.
Save them. You're probably gonna want them when you're older.
Mm-hmm. So I'll be on, like I said, I'll be on for a while. Then I got to hop because I got to get to DC to a lunch. But
no worries.
Yeah,
I appreciate you joining.
Yeah, nothing's more fun than driving into the city and trying to find parking for lunch.
Oh yeah, especially in the middle of the afternoon.
Yeah. Hi, Leslie.
How are you doing?
Good.
Please hold while I try to connect you.
Can you guys hear that?
Yeah, are we calling someone?
I was wondering if you have a way to mute the whole audience so that if somebody...
Yeah, the audience is muted, so maybe it's Paul. Paul, are you calling in?
Your call has been forwarded to the voicemail for Paul Joffrey Jr. No one is
someone was
available
calling
to
him.
take your call. At the tone, please record your message. When you finish recording,
Oh, we get to
you
hear
may
his
hang
voicemail
up.
now.
Alexa, maybe he's trying to call in. Paul, you good?
Hey, everybody. Can everyone hear me okay now?
Yep, I can hear you perfect.
Okay. Sorry about that, guys. It's actually, it was funny. Scott, I think you called me by accident, and my phone kept ringing uncontrollably and I couldn't stop it, so I had to turn it back off. Sorry, Avaya phones.
No worries.
Yeah, so.
Well, it looks like we have quite a few people starting to join already. We'll probably wait maybe 1 or 2 more minutes, just give a couple more people a chance to join in. But for those that are already here, good morning, and glad to see so many familiar faces and names coming in. We promise to respect your time, so just know that we're going to keep this to an hour, so we're planning on ending right around 12:30. But we're super happy to have you for our Lunch and Learn today, covering an important topic, condos, and just know that this is a presentation specifically geared towards real estate agents. So this is not just us talking about lender stuff. I mean, this is stuff that's going to be relevant to you. So happy to have you here, and we're happy to be joined by Scott Figueroa, who is our Vice President of Collateral Risk here at Fairway, and Paul Joffrey, who is our Vice President of Collateral Quality, Training, and Support. I'll let them introduce themselves here shortly as they get their presentation started, but we're going to be covering a lot of the essential strategies to navigating a lot of the common financing issues specific to condos and help to ensure a smooth transaction for you and your clients. And we're also happy to be hosted today with Wade Vandermolen of Pruitt Title, who is the Vice President of Business Development at Pruitt Title. And I'll let him kind of introduce himself, but Wade's been in the industry since 2005, I believe.
Way too long, man. Way too long.
And he's well known in the DC metro area for not only making sure that your transactions go smoothly from a title standpoint, but he also has a passion for helping realtors grow and sustain their business. So I'll let him kind of give his spiel and talk about himself, but we're happy to have you, Wade.
Cool. You want me to talk now?
Yeah, you can go ahead now if you want.
Yeah. So so Wade Vandermolen, Pruitt Title, been in the business 2005. I was in Phoenix for 7 years. Been here 12. Run a website, dctitleguide.com, and do a lot of crazy stuff on YouTube if you ever check me out. But yeah, so we're talking about condos. Very, very good topic. So one thing that we do at Pruitt that we help our agents with is get more business. And just yesterday, I had an agent who is looking to do a pretty big marketing campaign to condos in Northern Virginia. And I pulled maybe like 12 different buildings for her and was able to remove the people that bought in the last 2 years, had purchased or refinanced in the last 2 years. I separated it from owner occupied to absentee owners. And I separated the absentee owners from out-of-state absentee owners to in-state absentee owners. and was able to get her phone numbers, emails, property addresses of all these people so that they could start contacting them, because as you know, there are a lot of people that are making home selling decisions for spring market right now, and especially those out of state absentee owners, right? Maybe they want to do a quick sale in December and get that off their books. We can help our agent partners reach those folks to get more business, or maybe people that are just looking to unload in the spring and hopefully getting most bang for their buck on top dollar. We can help you target market those folks as well. So at the end of the day, the agents that we work with, they want two things. They want more business opportunities, whether that's buyers or sellers. Most likely, a lot of times it's sellers, and they want more online exposure. So whether we're helping them with YouTube stuff, website stuff, social media, video, we do all of these things. And not only do we as a company do them, but I do them personally and been doing it for a long time. So I can help agents, create that exposure because they're fighting for eyeballs on the internet, right? They're fighting for eyeballs against their competitors, and also they're trying to find more ways to get their time back and work more efficiently to get more listings. So, you know what? If I'd invite you to talk to me, because I know that I can help you. I can help put you in a better position to go after condos, whether it's condos or downsizers or anybody else in general, but especially people, if you're talking condos. A lot of those, I had a condo in Scottsdale, Arizona, and I can tell you, if you have a system down, right, especially for these out of state people, it's like, hey, look, I got my stager, I got my cleaner, I got all this stuff. We can help you reach those folks. So anyway, Wade Vanderbilt and Pruitt Title. I'll just do a quick shout out to Richard and Leslie. Known Leslie for a long time, Richard as well, and they do a really good job. They're awesome at what they do. And you know what? If you're not giving them all of your loans, you should, because they're going to help you get to the finish line and make you look like a rock star. So thanks for having me.
Thank you, Wade. Very kind of you. And looks like we're about, let's see, 11:37. So let's go ahead and get started. Like I said, we want to respect your time. I will now hand it over to Scott and Paul, and we look forward to hearing what you have to share.
Yeah. Thank you guys. Appreciate y'all for showing up today and wanting to learn more about condos. Richard, I don't want to step on your toes. By chance, were you able to distribute this presentation to everybody, or?
Thank you for the reminder. So yes, just a quick reminder as well, this is being recorded. So just know that for those that are here with us today, we will be sending the recording out as well as the slide deck. So Paul, we did not send it ahead of time. So I'll let you share your screen, and we'll make sure to get that out to everybody after the fact.
Yeah, absolutely. So let me get my screen. I'll share it up, and we'll talk a little bit about, again, saving everyone time. We'll talk about ourselves a little bit. We can get that going. So. All righty, everyone. So again, welcome. Appreciate you guys having us on to talk more about condos, especially in the Delmarva area. Little tidbit beyond the introductions. I grew up in Maryland, so it's always good to talk to individuals in that region. A little nostalgia. But so one of the big things I do want to point out is the material. Condo material is very important, but from an operations standpoint and a guideline quotation standpoint, it can be very dry. So by all means, if you have any questions, we're going to run through this. You're going to get a copy of this. Any questions, just bring them to our attention at the end. We are going to have an open Q&A. We find that the majority of issues that you're dealing with in the marketplace, on the ground, can be really discussed openly in a Q&A session, and you get a lot of it out of it. This information is great, but again, we're going to get through it. It's a grind. But I'll start with myself. Again, my name is Paul Joffrey. I'm one of the vice presidents for collateral quality training and support here at Fairway. 18, close to 19 years of time in operations and risk management. The past 14, almost 15 years has been specifically in collateral condos. If you guys do have work in the DC market, you might have touched co-ops. I've done co-ops as well. Started in operations in 2006 as an underwriter for TransUnion. Moved on to as an analyst for another company after that. Got into mortgage at peak time during the recession. If everyone's been around long enough to remember the recession, so I picked a good time to get in there. Since then, kind of been a jack of all trades. Other than having Scott's position, I've done pretty much everything, and Scott the same way. I've processed. I've been an underwriter, trainer. I've came on board with Fairway about almost 7.5 years ago to actually build out their quality and their training department, which this training group is part of it. This training session is part of it too. AVP, VP, team leads of team leads, you name it. I've been everything and anything when it comes to the collateral side of things. So there's a lot of firepower behind Richard and everyone here at Fairway from the sales perspective. A lot of individuals here that can help out. That in a tight nutshell is myself. Scott, did you want to talk a little bit about your background and what you currently do and offer for Fairway?
Sure, I'll go quick. I hope everybody can hear me okay. I did switch over to computer audio because for some reason it was my phone that was calling Paul, so I'm not sure what was going on with that. Scott Figueroa, I'm the Vice President of Collateral Risk. I've been with Fairway for almost 8 years now. Came on board to try to help bolster up the condo support process that we have for our branch network. Shannon Prochnow, who you may have dealt with if you're on the Fairway side, is the Vice President of Project Reviews. Shannon reports to me. Shannon oversees the actual condo review team itself. I've been in the commercial residential real estate for over 26, almost 27 years now. Spent 5 years of that working in commercial and residential property management and development. And then I got into the mortgage business in 2003 and spent some time on the credit side, and then moved into the collateral side in about 2008 when the mortgage downturn happened and I had to change focus a little. But I've been in the collateral review space, dealing with condos and co-ops and PUDs and different real estate type entities for over 20, almost 22 years now. I guess time's gone fast. But as Paul said, our team here at Fairway, we have a lot of expertise. If we throw Shannon into the mix, Shannon has over about 12 years worth of experience. She also comes from a title background, so she understands the title side of things as well. So a lot of knowledge, a lot of experience. If you do any co-ops in the DC market, I personally do all the co-op reviews. So we don't do a tremendous amount of co-ops, but we do have the opportunity to do co-op lending here too as well, even though that's not focus of our conversation today. But I'll turn it back over to Paul and he can get rolling forward in this presentation. But again, please bring any questions you have to us. What's most important to us is to answer the questions you have that we may not cover, because that's the important thing.
Thanks, Scott. Appreciate it. So again, this is a pretty good slide here, talking about what's the difference between a condo and a townhome. I know on the street there's a lot of the concept is that townhome means PUD. So to give you a little bit of background on that, not often is a townhome a PUD. A townhome can be a PUD, but condos can also be townhome style properties. They can be detached properties, things of that sort. So when we hear the word townhome, we have to dig in a little bit deeper when it comes to that piece of it. More than welcome to give you guys some more idea beyond this slide as to what we have to look at and what you have to do. Obviously, you're looking at homes. You're not digging into legal docs. Wouldn't expect you guys to do that. But in reality, a townhome is a style of housing development. It's not the legal classification of how the project's been developed. So it doesn't show legal ownership and things of that sort. I bring that forward because that is a big question that we get from other lunch and learns and from our sales partners as well, over here at Fairway. So in short, to give you a little bit of an idea as to what Virginia specifically, since, Richard, you're in the Virginia market, most states run on the same tome as well. But in Virginia specifically, a condominium is created by recording condominium instruments, which can be your declaration, bylaws, your plans and plats, any amendments and supplements to those documents as well. According to Virginia Condo Act, it defines a condo as a type of ownership of multi-unit property in which each unit owner has a separate deed to their unit and an undivided interest in the common areas of the property. So in reality, a PUD, you own the structure, you own exterior and interior of the structure, and you own the lot. That's the most generalized way I can put a PUD. So in essence, that's why a lot of people call them townhomes PUDs, because of that notion that the notion is that you probably own the lot, et cetera. But with a condo, you own the air space within your unit. You don't own the exterior. You don't own what's inside the envelope of the walls. You just own what essentially is, we've heard the term numerous times, walls in. So that's the difference between it. Obviously, you're showing a home. You're not going to look at a property and go, what, that's a PUD, that's a condo. You got to do a little bit more digging when it comes to that piece. But in general, that's really what it is. When we look at legal descriptions, that's one way, kind of pulling back from, title. One of the things we'll look at is, is the ownership interest in the legal description inclusive of a lot? Or is it just say a unit and an undivided interest in common elements? That's one way for us to determine if it's a condo or a PUD. Just bare bones looking at it from a title perspective. Okay. Oops. All right. So some tips here. So what can you do and provide upfront to Richard and everyone else at Fairway from a sales perspective to help things along? One of the first things that's not in here is if you guys are ears to the ground. You guys hear if you're doing business consistently in a condominium, you'll hear if there's problems with lending. Other lenders aren't doing it because X, Y, Z. I would say if you ever hear that, that is the first thing you want to make sure to let the our branch network know. Hey, this project's having trouble because balconies are being repaired. That should prompt our team to send it. Should prompt our sales team to send it over to us and say, hey, what do you think about this? And we can give some insight from that perspective. That's probably the first thing. If there is some lending concerns, always reach out to your Fairway, sales team. They get in touch with us, we can give you some of that insight up front. Most times we need some sort of documentation to look at, but that's one of the first things that I would say. If you're hearing things on the ground that there's issues, don't hold it in, let us know, and we'll see if there's something we can do. And that kind of falls into the first bullet point here. Have there been any inspections, structural or mechanical, done in the last 3 years? All lenders, if they're selling to Fannie and Freddie, they have to get a copy of those inspection reports. 3 years isn't an arbitrary number. That is a hard number that Fannie and Freddie have in their guidelines. So whether it be in a reserve study, an inspection, structural, mechanical, or otherwise, all lenders need a copy of it. So if you're able to snatch one of those up, hey, can you look at this? Tell us if there's an issue. We can do that. Another thing that pops off too as a red flag is special assessments. And I won't read these off to you, but there are some things that all lenders, and again, this is hardwired into the guidelines, that we have to confirm. Purpose of the assessment, is it planned? Is it already ongoing? How much is going to be collected? One of the things is there any delinquency? If it's an ongoing special assessment, what anybody not paying? That's one of the big pieces. And then we have to look at that and bump that up against guidelines. Again, get that over to us. We'll look at it. A lot of times the biggest issue with a special assessment is that it usually falls into, we had to do a special assessment because the roof has been leaking for the past 5 years and we have to get it fixed. Or, the roof was leaking. Somebody pulled the roof up and there's dry rot. There's water intrusion that's caused damage to the structure of the building. Those are the things that raise red flags more so than anything when it comes to a special assessment. But it's all incorporated in the guide rails right now. One thing that we do that's a cut above a lot of lenders is you can get pre-approvals done, with Fairway. We don't necessarily need a loan. If you have a building that you want to send a bunch of business over to us, but we don't have a loan yet, you just want to get it approved. If you send over the project documentation over to your salesperson, they'll get it over to us. We will review the project outside of having a loan, and pending an appraisal, title, flood cert, and potentially borrower's coverage, we'll approve the project. That's not a problem. That's for established projects, and any new construction projects that you have going on, we'll do that for that as well. Even if you don't want a full approval yet, if you know there's issues with the project and lenders are having trouble with it, you don't even have to go to that point. You can send, hey, there's litigation. Can you look at this litigation and tell us that there's an issue? That we can even look at. My team in our support group, they actually are trained to underwrite those things. They are probably better than most underwriters in the industry because of so much that they have to look at and how long we've had this process. We've had it for quite a few years now. They'll look at that stuff as well. And it's not just for conventional. I know Northern Virginia market's not very FHA friendly, but we look at single unit approvals for that as well. If you've heard of that, or what they call a spot approval. So, okay. So, okay. So a lot's changed in the so a lot has changed in the past few years when it comes to what condos and what Fannie and Freddie are looking for from that perspective. So everyone is probably aware of the collapse of the Champlain Towers. That was really the beginning of a massive overhaul that started in January of 2022 for Fannie Mae and Freddie Mac. After the collapse occurred, Fannie and Freddie issued temporary guidance that surrounded critical repairs, essentially. Started in January 2022, and then recently in collaboration with FHFA, and recently it's been a little over a year, September of 2023. Fannie and Freddie both worked to formalize some standardization of their policy. So what that means is Fannie and Freddie now align with each other, and it does relate specifically to critical repairs, special assessments, and the need for inspection reports. So September 18th of 2023 and after, if you've been asked for things and go, what the heck are they asking us for this for? This is why. Big changes occurred with it. But the good thing is Fannie and Freddie had some variations of guidelines that they didn't align with. So, you'd be asked for some stuff and then, hey, it doesn't qualify for Freddie. Let's look at Fannie. That kind of goes away. Now it's just one big piece of the pie. So specifically, and again, this is where the desert starts getting really dry in terms of material. This is directly from Fannie and Freddie's guidelines, so bear with us. But this is what they define as critical repairs, and this is what lenders have to review to ensure that it meets guidelines. So, in short, projects in need of critical repairs are those needing repairs or replacement that significantly impact safety, soundness, structural integrity, or habitability of the project's buildings, or the financial viability or marketability of the project. So this is something that has come up quite a bit. We get a lot of questions about it. There's been times where, and there's excessive water leaking in the building envelope, which is the in between the exterior wall and the interior wall. We see a lot of that in the greater Northwest. But, we'll have things where engineers will say this project doesn't need an evacuation order. No one needs to be moved out. It's still structurally okay while the building envelope is getting done. The big question we have is, well, if the engineer is saying no one has to move out, why can't we lend there? And a lot of times we can't lend in projects that have, excessive rotting and deterioration of the building's envelope. The big reasoning is that, Fannie and Freddie, they're not in the business of lending in buildings that are at the verge of collapse, and that's obvious with the Surfside Tower incident that occurred. That also means they're not interested in working in going in projects that have issues where there's significant damage done to the project, even if it is livable. So I want to make sure that you guys have a little bit of an understanding that just because the building isn't evacuated and it's not falling down, there are things that are considered critical repairs that are way before that. And some of these things are in the bullet points below. It's material deficiencies, if left uncorrected, have the potential to result in contribute to critical elements or system failure. Again, they're not waiting till the building collapses to where they're going to shut off lending. It's if it's not corrected or it's currently not being corrected, the potential result of it. Any mold, water intrusion, or leaking that's damaging. Advanced physical deterioration. Any project that's failed to pass any state, county, or other jurisdictional inspection or certification. Any unfunded repairs costing more than $10,000 per unit that should be undertaken within the next 12 months. Okay, these are repairs that don't include being funded through special assessments. This is the one part of the guideline that is relatively arbitrary. If damage or deferred maintenance is isolated to one or a few units and does not impact safety, soundness, structural integrity, or habitability of the project, these requirements do not apply. Fannie and Freddie do not define a few units. A few units to them is not a few units to every lender. So if only a certain section of units are compromised with something, we'll look at it. Doesn't mean we can do it. Doesn't mean we can't do it. It just means we're going to have to look at it and get comfortable with it. And that might mean additional documentation besides, the regularly mandated stuff that we require. Again, that we're willing to work with that stuff. For instance, if you have a project that's 20, 30 buildings. If one building has a fire and they're rebuilding it, Fannie and Freddie historically have said they will not do business in it. Well, one building out of 20 to us may mean a few units. It's an unfortunate event that might happen, but to Fannie and Freddie, they do not consider that a few units. That's some of the things that differ. One thing to point out: routine repairs are not considered to be critical. So if it's preventative in nature or part of the normal capital replacements, basically, if your roof has got to be replaced in 20 years and they're replacing it right now at 20 years, that's normal wear and tear. That's normal maintenance. If it's something that's accomplished through the normal operating budget or through special assessments that are within guidelines. Any project that has an evacuation order due to unsafe condition, either partial or total, is ineligible until the unsafe condition has been remediated and it's deemed safe for occupancy. So that's critical repairs in a very large nutshell. Special assessments, we kind of touched on this, but special assessments can be current or planned. Either way, we're going to need this information. We do get a little pushback when we're thinking about it, but we haven't done it yet. That's still something we need to kind of get an understanding for. That means something is going on that, is either going to be handled now or it's going to be handled at a later date. We would still need to know. So the bullet points there, why are you doing a special assessment? When was it approved? Is it planned? What's the original amount of the special assessment and the remaining amount to be collected? When do you expect it's going to be paid in full? One piece that makes the project ineligible for limited reviews and full reviews. There is something that can be waived with a limited review, and that's just general HOA dues when it comes to delinquency. If there's delinquency that exceeds Fannie and Freddie's thresholds for a special assessment, you cannot waive that with a limited review. I'm just bringing that forward because that's been a confusion point as well. But no more than 15% of the unit owners can be delinquent 60 days or more on any special assessment. Whether it's one of the three that they have going on or just singular. If a special assessment is associated with a critical repair and it's not fully completed, meaning 100% repaired, project is not eligible for financing. Again, inspection reports, it's hardwired into guidelines as to the time frame we have to look at. If a structural or mechanical inspection was completed within 3 years from our review date, we have to obtain it. No ifs, ands, or buts. Okay. It can't indicate that there are any critical repairs, evacuation orders, or regulatory actions. Okay. Of course, if it shows any of that, it's ineligible until all required repairs have been completed and we can document it. An engineer report or something that's considered substantially similar to an engineer report can be reviewed to determine repairs in regard to that. Lenders may need a combination of docs to determine if it's eligible. Okay, so some things that we can get if an engineer report was not done or an inspection report was not done, but there are red flags for critical repairs. We can get board meeting minutes, reserve studies, list of special assessments, or anything substantially similar. Usually when we run into this where, there's no engineer report, but we know there's something going on with the projects that's been told, we'll usually ask for financial statements, financials and board meeting minutes. Usually that'll help us get to the bottom of what's going on. But again, it's whatever we can get our hands on to kind of figure it out. One of the things that we as a lender, and I'm sure other lenders are running into, is we have a lot of HOAs and a lot of management companies that do not wish to give this documentation and information to us. A lot of times it's because their legal counsel has told them not to provide this information to us when it comes to critical repairs or inspections. Unfortunately, and this is directive from Fannie Mae and Freddie Mac. Fannie Mae actually has an FAQ that you can find on their website that discusses what happens with this. If we can't get anything to determine if the project meets the guidelines, we're not permitted to approve the project and sell it. So and that's been a challenge. We want to help the project. We want to see if we can get it approved, but there's a lot of pushback from that perspective. You guys are probably already well aware of that, but just kind of reinforcing that. Another thing that changed, and there was some clarification of this topic, I believe it was May of this year, but common master insurance issues. Now, a lot of these master insurance guidelines have been around since long before I was in collateral, so 14, 15 years. So what's happened is that the insurance industry has changed quite a bit, and a lot of this has to do with the high cost of catastrophic things, probably a lot of claims, things like roofs when they're at their useful life, and saying that there's wind and hail damage, things of that sort. Hurricanes, if you're anywhere near Florida, you've probably heard a lot about what's going on in Florida. A lot of private insurance institutions are vacating because it's too high of a risk. But a lot of this stuff is becoming an issue, not because the guidelines have changed, but because the insurance industry has changed. A lot of HOAs are getting pressed, and a lot of individuals. I'm not going to lie to you, my insurance premiums went up astronomically. Not as much as places like Florida, but enough to where I didn't like it. That's all correlating to it. If you want insurance that you had 5 years ago, you have to pay a lot more. And a lot of times it's hundreds of percentage points higher than what it was in previous years. And a lot of HOAs are trying to find ways to not pay that much money, make it more reasonable and affordable. And what they're doing is they're increasing deductibles, they're limiting coverage. They're doing things that are starting to impact their eligibility. Frankly, too, insurance companies are pushing back on HOAs that are in high risk areas. It's more difficult to get wind and hail coverage in places like Colorado, hurricane coverage in Florida, actually pretty much any coverage in Florida. If you're near the wildfire lines in California, you may not be able to be insured for wildfire at that point. So all those things are also pushbacks from the insurance industry that are impacting HOAs and condos in general. One of the biggest one that is more and more becoming a nationwide issue as opposed to a regional issue is excessive deductibles. So for all deductibles within a hazard policy, none of them can exceed 5% of the hazard limit that they have. And there's a few that you'll run into. You'll run into the typical per occurrence one, which is, anytime you have a claim, you pay $2,500 for per occurrence. Then you have some that are, $2,500 per occurrence, but if you're in an area where wind and hail claims are really high, you might be at 10% of the hazard limit. That would make the project not approvable. So that would be an occasion where it'd be per occurrence, but there's more than one deductible. And then one we're seeing very, very, very often, pretty much all over the country, as far west as Hawaii, is the per unit deductible. Those are 5%, it's $25,000 per unit for water damage. That's one that we see on a regular occurrence. If it's a per unit deductible that is geographic, and an example I'll bring up means is it common and customary in a certain region. Ice damming would be common and customary in colder weather parts of the country. Doesn't mean that ice damming can't occur in where I live in North Carolina or in Texas. It has happened in Texas when they had that big freeze, but it's not common and customary there. That would be considered geographic. There is something that we could potentially do for those per unit deductibles if they exceed 5%. And that's, obtaining loss assessment coverage from the borrower's HO6. We can offset it from that perspective. However, if it's a deductible that can happen everywhere and is common and customary everywhere in the United States, that would be called non-geographic. Fannie and Freddie will not allow a borrower to offset those deductibles with HO6 or loss assessment coverage through HO6. The one that we see the most is water damage. Not to be confused with flood. Flood coverage is different than your water damage coverage that happens in your hazard policy. That would be if you have a burst pipe in your unit and it causes damage. Obviously, a flood is if there's actual catastrophic flooding caused by a natural disaster or a flood of your your tributaries, your rivers and such. That's the one we run into the most. As recently as June 1st, Fannie and Freddie, again, FHFA required this. They wanted to clarify some property insurance requirements to promote sustainability, sustainable home ownership, and ensure all properties are sufficiently insured. Basically, they made Fannie and Freddie align with each other. And to be frank, through audit, they noticed that a lot of lenders weren't following these guidelines. So they made sure to clarify it, but also make sure that they aligned with it. There is a certain amount of perils that need to be covered in an insurance policy for condos and for pretty much everything. It's pretty long. I'm not going to go into extensive detail. If you have what's called a broad form coverage insurance policy, then you should be able to meet all of it as long as you're not excluding anything further. But that's the absolute minimum that Fannie and Freddie require, is a broad form coverage policy. Most policies are written at special form, which covers everything. They removed lenders having to obtain evidence of guaranteed replacement cost, extended replacement cost, and replacement cost. They also removed co-insurance requirements. Now, this all sounds great, like we don't have to confirm all this, but really it's removing redundancies from their guidelines and compartmentalizing it into one thing. And how we have to do it now is different, and you might be feeling it and seeing it. Obviously, you're probably feeling it and seeing it with us if you send deals to us. But essentially, they removed co-insurance. Co-insurance is a red flag for not being properly insured. Replacement cost, extended replacement cost, and guaranteed replacement costs are all well and good in theory, but it does not mean that the amount of hazard coverage they have is 100% of what's called the total insurable replacement value of the building. Basically, the amount of hazard insurance isn't enough to cover the entire property, and if there's a catastrophic event that causes a total loss. You can have 100% replacement cost, but that may not be enough to actually replace everything if there's a catastrophic and total loss of the entire property. So what Fannie and Freddie have asked is they've asked lenders to get something in writing. We try to take the path of least resistance and just ask for an email from the insurance agent to just confirm that the amount of hazard coverage they have right now is at least 100% of the total insurable replacement value as of the current policy effective date. What that means is when they renewed, the HOA and the insurance agent made sure that what they have in terms of hazard coverage is 100% of what they need if there's a total loss in the property. That's all we're trying to figure out. If we can't confirm that through that means, we can ask for a valuation report or an appraisal. I'm not sure if Virginia restricts lenders for asking for that. There are some states that do, namely Florida, I believe North Carolina as well. But we can use other things of that nature too. And basically it's an appraisal of sorts where it tells you this is how much it's going to cost to fully reconstruct the building. It's usually done by the insurance carrier. If we can get that in lieu of the email, we'll take that. But of course, an email from the insurance agent works wonders and fixes a lot of that. We do have databases at our disposal. We do keep documentation for historic purposes. If we can see that the HOA has been increasing coverage over time, or we can see that they are at 100% of the total insurable replacement value outside of this stuff, we'll leverage that. But again, that's commensurate with us having proper documentation on hand from prior reviews and recent documentation to confirm that. But again, that's something we can do internally. That will be vetted before we ask you guys or before we condition out for that extra stuff. Some other issues that we run into that I'm sure you do as well is, budgets not meeting the 10% reserve requirement, not having fidelity bond coverage or sufficient fidelity bond coverage, any type of litigation that's not considered minor in nature. Unless you're in the Florida region or you're dealing with Virginia Beach, or you're over on the Ocean City, Maryland side of things, condos may not be running. You might not be running into too much of that. But if you do, back in 2020 and 2021, there was a huge shift in how Fannie and Freddie look at condo hotels. Fannie went from being very loose to extremely stringent to the point to where it's borderline ludicrous if you ask me. But again, these only really impact the coastal mountain and lake property. So if you're not focusing on any of that stuff on the Ocean City, Delmarva Peninsula, over on the coast or in Florida, it's not probably going to impact you that much. Okay. I wanted to make sure that I got everything in there. It gives us a little bit about 20 minutes to take any questions or anything that you might have.
Yeah, thank you so much. Thank you so much, Paul. I'm gonna go ahead and unmute or allow everyone to unmute themselves, because I think it might have automatically done that. So if you do have questions for those in the group, you can either put the questions in the chat, or you can go ahead and unmute yourself, and I'm sure Paul and Scott would be happy to address them.
Sure. I see, Leslie, you have a question. Can you explain what HO6 coverage is? HO6. So there's two types of coverage we typically see with condos, HO3 and HO6. HO3 would be insurance that covers your exterior, your interior, in general terms. That would be if the HOA does not cover any of the actual structure itself. Most condos, they do, and most condo acts require them to cover at least the exterior and everything up to the walls inward. Up to the walls, not to the walls inward. So you don't see that very often. You might see that with detached condos. You might see that with townhouse style condos, but those are few and far between. Mainly HO3 is going to cover your exterior and interior, so we don't see it very often. With HO6 will cover the interior of your unit, which is what your responsibility is and what your ownership interest is in a condominium. So it's dependent. There are HOAs that will cover the interior of your property, of your home and your unit, up to original specs, which means up to builder grade. So any betterments and improvements that you have may not be covered. So HO6 will cover that. HO6 will cover the entire interior of your unit. That is your ownership responsibility. So that's really what HO6 is in a nutshell. It's coverage in the event the HOA doesn't cover the interior of your unit. And let's see. Yes, so there is a separate guideline as well, Leslie. It's the exact same. It's 15% of unit owners 60 days or more can't be delinquent on HOA dues. Now, the big difference is that if it's just HOA dues, it can't go a full review, but you can get a limited review to waive that. And that's usually how much the borrower is putting down in terms of LTV, CLTV, HLTV, and its occupancy, primary, second, or investor. There is a pathway around that when it's just HOA dues. But if there's a delinquency that exceeds 15%, 60 days for special assessments, that can't be waived. That'll make the project not approvable for limited and full reviews.
Okay, can you guys hear me?
Yep, I can.
Yes. So part of the reason I asked those questions, just for the benefit of who's on the call, is HO6 basically is what the buyer is getting for themselves on the difference between what the master insurance policy is not covering. So the master is the full condo, the HO6 is the borrower's portion of it. And sometimes we hear things that, the buyer's real insurance agent is saying, oh, you have enough coverage, you don't need any more. And so then there's a little bit of infighting. And then sometimes the realtor hears about it and is upset at the lender, like, my buyer has enough coverage, the insurance agent says I do. But I think based on everything you're showing today, it's clear to the realtors that are on this call that, there's a lot more to it going on behind the scenes, that lenders have to follow the Fannie Mae and Freddie Mac guidelines in order to get these condos approved. So that's at work behind the scenes. And those are the reasons that you've pointed out in your presentation as to why lenders are having to push for these things.
Yeah, 100%. And like I said, we have some internal benchmarks that we're looking at when it comes to HO6 specifically, and then we can talk about all the other stuff as well. But we have an internal benchmark, and we do look at we do look to see if lesser coverage is required. And again, it is very situational. It's depending on, what's been upgraded in the unit. We do see units that are immaculate. They have incredible amounts of upgrades, but then you see building ones that haven't changed since 70s or 80s. Each one of those have different requirements, but we do have a general benchmark that's not in guidelines. It's our personal benchmark, what we're comfortable with, that if you or your borrower wants to get HO6 before we look at it, by all means, you're more than welcome to. It's 20% of the appraised value. That's our starting point. That used to be a Fannie and Freddie starting point as well. But again, if you would like to say, hey, can you tell us, do we need that? That would require us taking a look at it, looking at the unit itself, looking at what the HOA does cover, because like I said, that they may not cover any of your unit. They may cover some of your unit. They may cover the whole shebang, but that's something that we can definitely take a look at. It's just, like I said, it's for ease of use. If your borrower is okay getting 20%, you can't go wrong getting 20% of the appraised value. Even if it's more, it's still protecting the borrower substantially. Or you can hold off, and we can tell you how much you would need in that capacity. So from that perspective, and yes, with all these changes that have gone on since last September, not this one, the one prior, you're probably seeing a lot of alignment with lenders when it comes to what we're asking for and how we're handling this, and that's because the playing field's been evened. I will say that I think we can look at things a lot more holistically. We look at things to see what's right, and that's where, like Scott pointed out, the 15 years that I've been in condos and co-ops, his 15 years in condos and co-ops, and Shannon's 12 plus years in condos and co-ops, that really pays off. That's a lot of expertise and firepower. A lot of our underwriting staff has been around for a long time, and they were trained by us, so they got a lot behind them as well. So, yeah. Thanks, Leslie. Anything else we can help you guys out with?
So one question I'll get asked sometimes by agents that are either writing an offer or one's just been accepted is that if we tell them there's an issue with the condo, we get some of the documents back. Oh, well, they'll let us know that, well, someone just sold a unit 6 months ago or a year ago or something like that. So, I mean, can you kind of address that? I mean, I'm sure there's obviously things can change, things pop up, but I mean, are there instances where we wouldn't be able to do something that someone else would be able to do from just a standard conventional Fannie Mae, Freddie Mac loan standpoint?
Scott, I can add a little bit if you want to just.
Yeah, I can. I'll give your mouth a break. You've been talking for a while.
Appreciate it. Thanks.
Yeah, I would say generally that's on a case-by-case basis to some degree. Lender interpretation of guidelines is at the lender's discretion as to how they rep and warrant to Fannie and Freddie seller guides. It's also possible that things have happened in the last 6 months. As Paul had touched on, with the insurance, we're seeing a lot of changes within the insurance industry as HOAs are renewing policies. We're seeing insurance that was good 3 months ago that now they've gone through a renewal period and now is no longer acceptable. And that's, sometimes out of the HOA's control and sometimes it's not. They're looking for ways to save money. They're increasing deductibles and things. If you're getting into critical repairs, deferred maintenance and things of that nature, if that can be a little subjective, as to how different lenders may look at things, as far as, how are they closing those loans? Did somebody do a portfolio product before? Was it a big bank that has a balance sheet and they're carrying that on their portfolio versus actually selling these to Fannie and Freddie? I will say a lot of those types of things around deferred maintenance, special assessments, critical repairs, I think most lenders align on that. I mean, I sit on a Freddie Mac advisory board that has, pretty much all of our peers on there, and everybody pretty much aligns on those requirements. But what we also don't know is, what was disclosed in that prior review to the other lender. We see things, unfortunately, that are not accurately disclosed sometimes that, will come up. But, we are contacted quite often. Paul's team on our support mailbox is contacted, say, hey, we have a fallout, we have a rescue deal from another lender. So we do see that, everybody's looking at these things, and rescue deals are tough because, usually they're insurance related or they're critical repairs related. Those are the two things that we're seeing most often. And then it also depends, just also, obviously you're in a market where, you might run into a lot of VA loans, VA condo approvals. Once it's VA approved, it's approved until VA pulls their approval. So you could have had a sale 6 months ago that had VA financing on a condo that was approved that may not be eligible conventionally, but VA hasn't pulled their approval yet. So there's a lot of different variables that go into, when other units change hands versus, what we may find as a factor of eligibility today. One other piece that I'll touch on quickly as well. If you're doing business in Maryland, there was the HB 107 Maryland Reserve Study Law that went into effect last November, I believe it was. So if you're dealing with a property in Maryland, the reserve study law required that all HOAs have reserve studies done on their properties. And I believe that was prior to the end of last year. So if you're listing a property in Maryland, there's a good chance that either they have done a reserve study or they're waiting to have it done. Last I heard, there was a long line of, there's only so many people that do reserve studies, and they were overwhelmed with work, because this was not only condos, but it was all HOAs. I think it's with over $10,000 in assets, which is pretty easy to acquire. So that's detached PUDs, attached PUDs, condos, co-ops, anything that might be in DC or in Maryland falls under that law. So, always good to ask, as we mentioned, one of the recommendations up front, if you're listing a condo or if you're working with a client who's looking at a condo, are there any inspection reports in the last 3 years? There's a pretty good chance that there's going to be a reserve study out there in Maryland. So I would inquire about that. Not only is that important for our buyer as they're looking at these condos to see, hey, what is my future expenditures down the road? But also from a lender perspective, that is something that we would have to analyze to see, is there any critical repairs out there that are going to have to be addressed? So I just wanted to touch on that quickly, because that is something that is out there in the marketplace now for the last year or so.
On the heels of what you just said, since the agents, a lot of times they're going to be taking a listing in a condo building. In addition to what you just mentioned, what are the other things they can be asking for if they wanted Fairway to take a look at their condo, like ahead of time while they're preparing the listing? What type of documentation should they be collecting and sending into us so that you all can review that? And how long would that take for them to get an answer back?
I mean, if it's just an overall pre-review process, I mean, if you wanted to get a pre-review done of a condo to say, hey, is this condo fully eligible? If it's an established project, I'd recommend getting the budget, the insurance, and a questionnaire. Questionnaires can be a little tricky because typically HOAs or management companies are going to want to charge for that. However, if you're able to get that documentation up front, we can review it and see, are there any challenges that we'll have running into, financing this project? There's some general information. One of the first slides Paul had touched on was some of the tips we had for agents. And that was some of the things that we recommend asking up front. Are there inspection reports? Are there special assessments? And if there are, getting that information up front, if you're able to get that information to us, we can analyze that stuff as well. If they say, yeah, there's a special assessment because, we're, having to do some work on the building and we can get information on that, we can look at that and see, is it something that we may be comfortable with? That would speak for Fairway's comfort level. It wouldn't necessarily speak for all lenders, but we would be able to weigh in and give our opinion on it as to whether or not we see issues with that documentation. But yeah, anything that you might be able to get up front. I mean, if there's a building out there that perhaps has frequent listings in it, whether you're a seller's agent or a buyer's agent, we can always look at that project ahead of time, get that in our database if we've signed off on all the project level documents, and then we can know that we could lend in confidence, or if there's any issues there. So yeah, there are opportunities that we can look at things prior to any applications being taken. Paul, what are we, about 4 to 5 days on those? I think now volume goes up and down. It depends on how many we get in. Obviously, any pre-review, we give precedence to those with loans in process, because we don't want to have somebody waiting. But we try to squeak in those project level pre-reviews with no loans in about 4 to 5 days, I think. So we're not looking at huge turn times, but there's a little bit of period in that term. Paul, you're muted.
There we go. Okay. Thank you for the break, Scott. Yeah. So right now my team, it's 4 days we quote. Obviously it's a little bit of a slower time right now. If I have all my people here and where we're able to get to them faster, we will. This morning I was able to get to one that was a couple days. So pretty quick turn time. But that's what we try to do. We try to exceed our turn times, but we got to give ourselves 4 business days. As you guys know, holidays are coming up. People want time off. So again, that goes into stuff like that. But yeah, but it's a great tool. It's a great resource for everyone, especially if you want to maintain some business there. And like I pointed out too, we will actually do an approval subject to borrower documentation, appraisal, title, flood cert, and borrower's coverage. If you want to do multiple loans in a project, you just don't have a loan in process right now. So like I said, there's 2 different things we can do from that perspective as well.
Great. Well, guys, it looks like we have about 3 minutes left. Again, want to be respectful of everyone's time. Were there any follow-up questions from those that are joining us as guests that Scott and Paul might be able to answer before we close out today? Bueller. Well, if no additional questions, thanks, Leslie. Anything else that you wanted to add before we close out? Just a reminder, this was recorded, so we will be sending out to those who registered for the event, as well as providing the slideshow that Scott and Paul shared during the call today. But I guess anything else, Leslie, you wanted to mention? All right. Well, if no other questions, thank you everyone for joining. Thank you, Paul and Scott, again for the great informative presentation. I'm sure everybody got a lot out of that, and we look forward to working with you in the future on any new topics that come up regarding condos. We want to make sure that everybody stays well informed.
Yeah, please.
Absolutely. Our pleasure. Lot of information there. So if you get the presentation, you go over it and you have questions, feel free to reach out. We'll be happy to answer
Please.
those.
Absolutely. Please.
Thanks a lot.
Yeah.
Take
Take
care,
care,
everybody.
everyone.
Have a great rest of your day.
Bye-bye.
Take care.